Today, we have some exciting news from the Canada Mortgage and Housing Corporation. The CMHC is set to release its latest housing market outlook. This report is keenly anticipated by industry professionals, policymakers, and consumers alike as it provides a comprehensive overview of the current state and future projections of the housing market across Canada. The housing market outlook will provide insights into housing starts, sales, prices, and rental markets, offering valuable information that can guide decision-making for those involved in the housing sector. This year, the report is expected to address the challenges posed by economic uncertainties and demographic shifts. It will likely delve into how these factors are impacting housing demand and supply. For those who are new to the housing market outlook, it is an essential tool that helps stakeholders understand the dynamics of the housing market. The CMHC uses a variety of data sources and analytical methods to provide a detailed picture of trends and forecasts. This helps in identifying potential risks and opportunities in the market. The release of the housing market outlook comes at a pivotal time as Canada continues to grapple with high home prices and affordability issues. These challenges are not only affecting prospective home buyers, but also influencing the broader economic landscape. The insights from the CMHC report will be crucial in shaping policies and strategies moving forward. As we await the release of this report, it's important to consider how the findings might impact different stakeholders. Homeowners, potential buyers, real estate professionals, and policymakers will all find value in understanding the projected trends and the underlying factors driving these changes. Stay tuned for more updates as we delve deeper into the contents of the CMHC's housing market outlook in upcoming episodes. We'll be breaking down the key findings and discussing their implications for the Ontario real estate market specifically. So, make sure to keep listening for those insights. Let's delve into some significant news regarding the Bank of Canada's interest rate forecasts, particularly in light of potential U.S. tariffs on Canadian goods. According to a recent report from the Bank of Montreal, or BMO, Canada has received a temporary reprieve from these tariffs for at least 30 days. However, BMO warns that if the U.S. does implement these tariffs, the Bank of Canada may be compelled to cut its policy rate to 1.50% by the end of the year. This would be a full 100 basis points, or 1 percentage point, lower than BMO's current forecast, which expects the rate to reach 2.50% by the end of this year. The updated forecast from BMO is based on the potential imposition of U.S. tariffs, 20% on most Canadian goods and 10% on oil and gas. These tariffs were initially set to take effect today, but President Trump announced a last-minute 30-day delay, extending a similar arrangement previously made with Mexico. BMO economist Michael Gregory highlighted that if these tariffs are indeed enacted, a more aggressive rate-cutting cycle could become a possibility. He noted that such a scenario could push Canada-US overnight rate spreads beyond minus 225 basis points, nearing the all-time extreme set back in 1997. While any immediate action is postponed, Gregory mentioned that the tariffs have shifted from being an essential certainty to a risk. This perspective is echoed by economists at the National Bank, who argue there is a strong case for an emergency or larger than usual rate cut if tariffs appear imminent. They suggest that to mitigate the impact on Canada's real economy and support financial conditions, an emergency or intermediate interest rate cut by the Bank of Canada could be warranted. They propose that such an emergency action would likely involve a larger than normal cut of at least 50 basis points. Beyond these immediate considerations, the National Bank also predicts that scheduled rate cuts in March and April, each amounting to 25 basis points, could lower the policy rate to 2.00% by the spring. It's important to note that these tariffs are expected to exert significant pressure on the Canadian dollar and economic growth, with some experts warning they could even push the economy into a recession. Additionally, there could be inflationary pressures if tariffs persist. However, it's crucial to remember that much of this remains speculative and depends on developments over the next 30 days. As part of the agreement to delay tariffs, Canada has committed to enhancing border security and controlling the flow of fentanyl by working closely with U.S. officials. This initiative includes expanding Canada's $1.3 billion border protection plan, designating cartels as terrorist organizations, and launching a new cross-border task force. Furthermore, Canada is allocating an additional $200 million to combat drug trafficking and appointing a fentanyl czar to lead these efforts. Let's talk about a significant development in the Canadian mortgage market. Frank Fintech Incorporated has launched a digital platform aimed at revolutionizing how Canadians find and secure mortgages. This initiative is set to create an online marketplace that offers more transparency and choice for mortgage consumers, addressing the often cumbersome and opaque process currently prevalent in the industry. Don Scott, the founder and chief executive officer of Frank Fintech, has emphasized the need for a more consumer-friendly approach to mortgages. He compares the current state of mortgage shopping to buying a car or a house, where consumers have multiple options to choose from, unlike the mortgage process where they often see only one or two options. Scott believes that the mortgage market should provide transparent product selection to borrowers, and his company aims to lead this change through technology. One of the key differences between Canadian and United States mortgage systems is the term length. In the United States, the mortgage term typically spans the entire amortization period, whereas in Canada, mortgages often have shorter terms within the amortization period, requiring renegotiation at each term's end. This complexity adds to the challenges Canadian consumers face when navigating the mortgage landscape. Frank Fintech's platform is not a mortgage lender, but a gateway for consumers to access the best rates and deals available at any given time. The platform aims to simplify the mortgage process by providing a seamless digital environment where consumers can easily find information and complete their mortgage transactions. This approach is likened to how Jerry AI simplifies car insurance policies. According to a report by Pramit Mukherjee and David Ljunggren for Reuters, the Bank of Canada has recently made significant interest rate cuts, which could potentially lead to lower borrowing costs. This is in response to economic challenges, including the impact of United States tariffs on Canadian goods. The Bank of Canada Governor Tiff Macklem has expressed concerns about the negative effects of a prolonged trade conflict on Canada's economy. The current economic climate influenced by these tariffs presents both challenges and opportunities for the Canadian housing market. As reported by Fergal McCallendon for Canadian Mortgage Professional, the full impact of these tariffs on the housing market is yet to be seen. However, Bank of Montreal's chief economist, Doug Porter, suggests that further interest rate cuts could occur if the tariffs continue to pressure the economy, potentially resulting in more favorable borrowing conditions for Canadians. Frank Fintech's platform is particularly targeting new home buyers, including Gen Z, Millennials, and late Gen Xers who are entering the housing market for the first time. With a significant portion of mortgages up for renewal in 2025, many Canadians may face higher interest rates than when their terms began. This presents a crucial opportunity for Frank Fintech to provide competitive options to those renewing their mortgages. Victor Tran, a Toronto-based mortgage broker and expert, notes that the competition among banks and lenders to attract and retain customers could lead to better deals for consumers. Frank Fintech's digital platform allows consumers to see available rates directly on their cell phones, offering a marketplace of options that traditional brokers may not provide. This transparency is expected to empower consumers to make informed mortgage decisions. Frank Fintech is also expanding its partnerships in the real estate and financial sectors to enhance its offerings. The company recently completed a capital raise of 1.5 million Canadian dollars to increase brand awareness and is focusing on partnership marketing to build its presence in the market. By leveraging these partnerships, Frank Fintech aims to grow its volume and provide even more value to its users. Canadians are catching their breath after a tumultuous day that ended with a temporary reprieve from the looming tariffs announced by U.S. President Donald Trump. Despite this relief, the specter of a trade shock remains, bringing long-standing issues like Canada's lagging productivity and interprovincial trade barriers into sharper focus. Productivity in Canada has plummeted since the pandemic, placing it among the worst-performing advanced economies. The Bank of Canada even went so far as to declare a productivity emergency last year. One significant factor contributing to this decline is high home prices, according to the Canada Mortgage and Housing Corporation, or CMHC. the CMHC highlights that Canada's affordability crisis is limiting population mobility, which has been declining for decades. This lack of mobility hampers productivity by preventing employees from pursuing better job opportunities and employers from attracting the necessary talent. Their study estimates that for every 1% increase in home prices in a city, there is a corresponding 1% decline in the number of people moving to that area. Taking Toronto as an example, the CMHC calculates that if Canada's largest city were to double its housing starts over the next decade to tackle affordability challenges, the population would be 3% greater than what is currently projected. This increase is crucial for fostering what's known as an agglomeration economy, where productivity rises due to shared resources, matched supply and demand, and the exchange of ideas. Aled Abyorworth, the CMHC's deputy chief economist, points out that Canadian cities are centers of excellence in innovation, spanning high-tech software to life sciences and financial services. However, high housing costs are preventing these productivity engines from reaching their full potential. Canadians who wish to move to these hubs for better job opportunities are often deterred by the unaffordability of living there. The broader impact of these decisions on where to live and work plays out on a national scale. They curtail upskilling, which is a key driver of productivity growth through the enhancement of Canadians' skills and knowledge. By not addressing high housing costs, Canada is missing out on opportunities for growth in these areas. Furthermore, if Canada aims to diversify its trade away from the United States, it needs to work on reducing its high dependency on its southern neighbor. According to Moody's Analytics, 76.3% of Canadian exports went to the U.S. in November. Moody's economist Kira Kendrick suggests that by increasing reliance on other trading partners, Canada could reduce its vulnerability to U.S. protectionist trade policies. The latest real estate data from the London St. Thomas market indicates a noticeable slowdown in home sales for January, with a 20.3% drop compared to the same month last year. According to the London St. Thomas Association of Realtors, or LSTAR, 370 homes were sold last month. Despite this decline, real estate officials are not overly concerned. Instead, they're optimistic about the market's prospects, particularly due to an increase in new listings. Bill Matter, Chief Executive Officer of LSTAR, highlighted that there was a 12% increase in new listings for January. He views this as a positive development, suggesting that more properties entering the market could signal a healthy level of activity and interest from potential buyers. We had an increase of just, 12% of new listings coming out for January, which is again a good sign, Matter said. The average home price in the London St. Thomas area rose to $639,486, marking a 4.5% increase from the previous year. This rise in home prices might reflect ongoing demand and the limited supply of homes available, even as sales numbers dip. The market dynamics suggest that while sales are down, the value of properties remains robust, indicating that buyers are still willing to invest in the area. This slowdown in sales comes amid another interest rate cut by the Bank of Canada, which reduced rates by 25 basis points at the end of last month. The move was somewhat unexpected, as many believed the previous cut would be the last for a while. Matter mentioned that the rate cut could influence buyer behavior, noting, "We thought the last cut was going to be the last one for a while. Now, with what's happening recently, that may change again. But I think when people thought that was going to be it for a while, they're more likely to come out and stop looking again." Overall, the real estate market in London St. Thomas seems to be in a state of transition. While sales figures are lower, the increase in listings and the rise in average home prices suggest a market that is adjusting to new conditions, possibly influenced by economic factors such as interest rates. Real estate officials remain watchful but optimistic about the future, suggesting that the market may find a new equilibrium as the year progresses. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.